Thanks for clicking! Concerns over the mortgage renewal cliff have been greatly exaggerated. This according to a recent article in the Financial Post by Rob McLister.
I love you.
Yet, the article from McLister comes amid a number of recent reports regarding the mortgage renewal wave, with some noting that the wave is already starting to push homeowners to list their properties, with the big six banks putting away hundreds of millions in loan loss reserves, and RBC noting that the increase in supply could be a result of increased stress showing up in Toronto's real estate market. Yet McLister says it's time to dial down the drama, offering 6 reasons why the mortgage renewal wall may be more like a knee-high picket fence. Clever. So what I want to do today is go over McLister's argument that concerns over the mortgage renewal cliff are overdramatic, take a look at what the data actually says, and then discuss why maybe one of his assertions could be somewhat right.
How'd you do that?
As we'll see today, this mortgage renewal wave is an ongoing story, one that will continue into 25 and 26, and we'll obviously continue to have updates out on this story on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this article. On to the article. First and foremost, let's be very clear about that which we are speaking. There are 3 types of mortgages set to be renewed over the next few years. Those with fixed mortgage rates, those with adjustable mortgage rates that fluctuate with prime, and those with variable mortgage rates with fixed payments, where even when prime increases when the Bank of Canada raises rates, the payment on those mortgages stays the same. The Bank of Canada has noted that in 2025, those with fixed mortgage rates could see their payments increase by 22.5%, those with adjustable could see a 40% increase, and those with variable with fixed payments could see a 52% increase. And the situation could get even worse in 2026, especially for those with those fixed payments but variable rate mortgages, when those payments could increase by up to 60%. For our purposes, we're not really worried about those with adjustable rate mortgages as their payments have increased as the Bank of Canada has increased rates over the past few years. We're more concerned with those with fixed payments. And McLister knows this, but as we'll see, it's conveniently omitted from most of the article.
Write it like no one will ever read it.
But McLister says that we shouldn't be overly worried about the renewal wave, as those set to renew their mortgage over the next few years have been pre-tested, with borrowers having to qualify at a rate of around 5.19%. So the argument is that although borrowers will see an increase in their payments upon renewal in 25 and 26, they've already been pre-tested for a rate around 5%. Therefore, renewing into a rate around 4% isn't that big of a deal.
Well, okay, if you say so.
And that's definitely true for fixed rate borrowers, those who took, say, a 5-year fixed in 2020 and 2021. But, as we'll see, it's definitely not true for those who took a variable rate mortgage with fixed payments, those 90-year amortizations that we've discussed before on this channel. Those are those mortgages that took out a variable rate mortgage with a fixed payment, where, when prime rose, their payment stayed the same. The only change was how much of their payment went towards principal and how much went towards interest. And when prime rose to such an extent that that fixed payment wasn't enough to cover the interest on that loan, the difference got tacked on to the principal. That loan amount increased, it negatively amortized, thereby increasing the amortization of those loans. So the big question becomes, were those loans pre-tested for the payment increase that are set to hit in 25 and 26?
I doubt it.
Let's take a look. Back at the height of the bubble in February of 2022, borrowers could get a decent variable rate mortgage at 1.7%. Let's take the benchmark price back then of $834,700. We'll use a 20% down payment, leaving a mortgage amount of $667,760, giving you a payment that would not change for the length of your term of $2,730. However, those borrowers had to qualify at 5.25.
Yeah, they're dumb. Really dumb.
Meaning they had to show the bank they could afford a mortgage payment of almost $4,000 per month, a 37% increase between that and what they were actually paying. But remember, according to the central bank, those payments could increase by 52% in 2025 and 60% in 2026. So, no, those borrowers were stress tested at a payment 37% higher than that which they were actually paying, when, in fact, they're looking at payment increases of 50 to 60%.
Why do you have to always be so overdramatic about it?
And it's these mortgages, these variable rate mortgages with fixed payments, that are the problem. Everybody knows this. The Bank of Canada has been warning about them since at least late 2022, most recently warning about their relative impact in the bank's financial stability review in 2024, and even in 2022, it was noting that it's those borrowers that were financially stretched the most that were more likely to take on variable rate mortgages to help them qualify, with 80% of those that took variable rate mortgages taking the fixed payment sort.
You have to protect yourself.
So, when McLister is eschewing the horrific predictions of a 60% increase in payments, he's talking about the central bank's own predictions. A central bank which is not exactly well known for downside hyperbole. And then, McLister fails to address the specific mortgages about which the central bank is referring. And it's not just the Bank of Canada that is warning about the renewals on these mortgages. Of the big six banks, there are three that allow for these negatively amortizing mortgages: BMO, TD, and CIBC, of which hold a total of $94 billion of these loans on their books. BMO's most recent support to shareholders show that over 21% of its mortgages have amortizations over 35 years, TD sitting at 16, and CIBC sitting at 22. And while these banks have been taking steps to get these borrowers to lower their amortizations, increase their payment, make lump sum payments, etc., the pace of those amortization reductions have been slowing down, with CIBC's chief risk officer noting that some are refusing to take those steps because they could not afford to do so. So, no, those with variable rate mortgages and fixed payments have not been perfectly stress tested on the rise in interest rates and are certainly not scoring extra credit. Second, says McLister, it's not as though mortgage payments are set to double, and our trusty government, his words not mine, has made it easier than ever for borrowers to extend their amortizations upon renewal. And with this, I think McLister is discussing the mortgage charter announced last year, which asks the banks to consider extending amortizations on renewal. That charter has been called nonsense by the mortgage industry, as banks are not required to participate in the charter's guidelines. That charter has no teeth, it doesn't have the rule of law, ergo, that's not really making it easier than ever coming from our trusty government. Next, incomes. McLister writes that incomes are continuing to ascend, with dual income households making $154,000 a year, having their incomes increased by 23% since the time they signed their mortgage. As such, says the article, even accounting for inflation and taxes, the 23% increase in income should help to neutralize the sting of higher mortgage payments. Now, though McLister doesn't cite his sources, providing us with a citation as to where he got the data that those making $154,000 a year have seen a 23% increase in their overall income, he does give us a link as to where we can find more articles on inflation. But sure, leave a comment as to whether or not your income has increased by 23% over the past 4 years. Regardless, is 23% that great when we account for inflation? Well, when we look at Stats Canada, food prices are up 23% since January of 2020, transportation is up 21%, gas up 41%, goods and services are up 17 and 18%. And these numbers, which would take up most of that 23% increase in income, only work if A, you don't factor in shrinkflation, and B, you trust all of the numbers being provided by Stats Canada.
Why would they lie?
Fourth, McLister says that interest rates can and should keep getting better going into that renewal cliff, which is true. We are seeing a decrease in fixed mortgage rates all across the board. And if that continues, which McLister says we should see another 44 basis points worth of decreases over the next 12 months, that will definitely help. But again, that payment from earlier for those with variable rate mortgages and fixed payments, they had a payment of $2,730. And it's more likely than not that their mortgage balance has seen an increase. Therefore, if we just take that original balance, not even considering an increase, put that into a 20-year amortization at, say, 4%, we get a mortgage payment that jumps $1,300. Not exactly doubling, but not exactly that great. But if those variable rate mortgage holders don't like that fixed rate, fear not, McLister says they can take a variable rate mortgage again, as rates are expected to be down another 150 basis points over the next 12 months. Those additional cuts would bring the prime rate down to 5.2. Remember, they had prime minus 0.75. That would give them a mortgage rate of 4.45, bringing the payment from $2,700 to $4,200 per month, a $1,500 increase.
Don't be so dramatic.
In sixth and finally, says McLister, this isn't borrowers' first rodeo, meaning a lot of the renewals that are coming up are from existing homeowners, those who had mortgages prior to 2020. And I think that's definitely a good point for those homeowners that didn't refinance their mortgage between 2020 and 2022 and didn't buy their house, didn't buy a new house between 2020 and 2022, weren't first-time homebuyers. They probably have a lot of equity left in their property. They're going to have a lot more options than those first-time homebuyers who jumped into the market during the pandemic and took a variable rate mortgage with a fixed payment.
You can't afford not to.
With all of that said, as errant as I think McLister's article is, and as much as I would like professionals to cite their sources so we can verify their data, the data shows that he's not all wrong, especially regarding the hyperbole surrounding timing. As we talked about before on this channel when we looked at the expected increase in mortgage payments coming up over the next few years, those with fixed rate mortgages aren't expected to see major payment spikes until about March of 2025, hitting their peak in 2026. And that's even more the case with variable rate mortgages, as we didn't really start to see their usage spike until mid-2021. So, is it likely that this renewal cliff, this massive increase in payments, are going to hit in March of next year, in March of 2025, in time for the spring market? I'm not sure that's likely.
Buy it now!
But is all of this concern over the mortgage renewal wave coming just drama, as argued by McLister? A 50 to 60% increase in mortgage payments for those with variable rate mortgages, which McLister does not discuss during the article, one of the very few articles ever that McLister doesn't discuss variable rate mortgages, is definitely not inconsequential. The central bank is worried about these extended amortizations. The banks are worried about these extended amortizations. OSFI has warned about these extended amortizations, and McLister of the Financial Post says it's nothing but drama. McLister says these mortgages were stress tested, which they weren't, that the government made it easy for banks to extend amortizations at renewal, which they didn't, and the incomes have increased to a point that, when even adjusted for inflation, they should be high enough to neutralize any increase in mortgage payments, which I don't think they have. So, is all of the talk about the mortgage renewal cliff coming from the central bank, coming from the big six banks, coming from the banking regulator? Is all of that hyperbole? Is all of that overdramatic? Well, if the expectation is that we're going to hit March of 2025 and we're going to see a flood of new listings as current homeowners are worried about the upcoming mortgage renewals, then yeah, I don't think we're going to see that immediately in March of 2025. The data just doesn't support it. With that said, as the usage of variable rate mortgages with fixed payments continued to increase throughout the pandemic, those mortgages that have seen their amortization increase to 60, 70, 90 years over the past few years, as those come up for renewal, then yeah, I think we could see some stress put on those homeowners. Because remember, a lot of those homeowners, especially those that bought near the end of the real estate bubble, haven't paid down any principal. Their principal has only increased over the past few years. With that said, we will obviously continue to track this mortgage renewal wave and its effects on the housing market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.